Netflix fourth quarter earnings just now crossing the wire. The stock is down, got about 3%. Let's get you those numbers. Netflix Q4 EPS 56 cents. I do not see a straight compare there. Q4 revenue 12.05 billion versus an estimate of 11.97 billion. Q4 free cash flow 1.87 billion versus an estimate of 1.46 billion. Turning ahead, what they see, Q1 operating income 3.91 billion versus an estimate of 4.18 billion. So that's a bit light. Q1 revenue 12.16 billion. The street was 12.17 billion. So that's basically in line. Q1 operating margins, they're calling for 32.1% versus an estimate of 34.4%. So undershooting consensus there. For the full year, they see 2026 revenue, they're calling for between 50.7 billion to 51.7 billion. The street was closer to 50.96 billion. So it does look, at least initially here, we're down nearly 4% in the after hours. Remember, the stock, since Netflix has last reported, that was October 21st, it was down around 30% from then because there had been these concerns about the fundamentals here with Netflix, the kind of growth trajectory for the company, the organic levers this company was going to be able to pull in light, of course, of this big headline-making transaction for WBD. Netflix, of course, did make some news on that front today, saying it sweetened its bid with an all-cash agreement there. But initially here, disappointed by investors with the stock down about 4% in the after hours. Geetha, I want to obviously get your thoughts on this WBD transaction, the latest news there. But why don't we start on this print and give me your take, Geetha, on the report. What do you make of it?
Hey, Josh, thanks for having me. So 4Q numbers look really solid, but I agree with you that the first quarter guidance looks a little bit light. But you zoom out to the entire year guidance, so 2026 revenue guidance, the magic number that we were looking for full year revenue guide was somewhere at around 13%. I think at the higher end of the range, Netflix is suggesting about 15%, so definitely much better than what consensus was expecting. But I think where they're falling short is the operating margin guide. So Netflix, I think, suggesting something like in the 31% range, whereas consensus and investors were looking at something like at about 32 to 33%. So still some questions to be answered on the operating expense front, whether the expenses are growing a little bit faster than what was initially expected, or whether this is just the impact of the Brazil tax, which we saw, the catch-up tax, which we saw last quarter, and whether it's just an extension of that. So some of those answers still to be gotten.
Some questions, Geetha, but I guess, listen, we're in the red in the after hours here. Since they last reported in late October, Geetha, this stock was down around 30% because, as you know, and you've written about it, there have been these concerns among some, investors about the fundamentals with Netflix, Geetha, about the growth trajectory for the company. I'm just wondering, when you look at this print, what line of sight you have into those broader questions.
Yeah, so I think the number one thing for Netflix management is going to be the engagement number. And this has really been the constant concern, Josh, whether the slowdown in engagement is what prompted the $83 billion deal for Warner in the first place. Now, looking first flush, you look at the 4Q numbers, they look really strong. I'm sure subscriber growth was really strong. Of course, they don't report subscribers anymore, but you just kind of look at the revenue numbers, you look at the operating margin numbers, everything looks pretty good. The real question is going to be 2026. And I think the big question here is whether they're going to increase prices, just kind of amidst this regulatory scrutiny, right? Are they willing to take the risk to raise prices and kind of be branded, maybe not so pro-consumer, especially as regulators kind of really, weigh down on the deal? So still a lot of questions there. But I think some of the high points were that they still are looking at advertising as being a big growth catalyst into 2026. So they're talking about ad revenue doubling in 2026 versus 2025. But again, more directional, and I'm not sure they've given us the exact numbers just yet. So it's still a little bit difficult to figure out, what the base is. But overall, I would say results are pretty strong.
Geetha, what is Netflix going to spend on content in the year ahead? And what's the content in the pipeline, Geetha, that you say, okay, consumers and investors, would be excited about?
So there was a lot of content to get super excited about in 2025. I mean, you had some of their hugest hitting titles. I mean, whether you're thinking about Stranger Things or Squid Game or Wednesday, these are, some of their biggest names. So those hit in 2025, and Netflix management team obviously repeatedly referred to 2025 as an embarrassment of riches. Now, I don't think they're necessarily going to have the same benefit in 2026. Yes, you do have a couple of, big returning titles, whether it's the Diplomat or the Night Agent or Bridgerton. All of those, of course, will move the needle, but not as significantly as it did in 2025. But what we're seeing in 2026 is that Netflix is making a much bigger bet into sports. So we already saw, the NFL Christmas Day games obviously brought in some huge viewership numbers for them. The Lions-Vikings game was actually one of the most heavily streamed game, ever in the history of streaming. So obviously very encouraging metrics. And I think that really kind of bodes well for them to make this bigger, bolder bet into live and live as well as sports content. So that's what we're going to see in 2026. But again, the slate not as blockbuster or as stellar as we saw in 2025.
Geetha, Netflix, we heard today, they did sweeten their bid for Warner Brothers Discovery, all cash agreement. Do you think that, Geetha, now increases the chances that Netflix gets this deal done?
They're definitely trying to get it on a fast track here, Josh. So one of the reasons there was to kind of really, assuage investors about the declining value of the stock. So there's a lot more financial certainty for investors. And then, of course, they're getting to speed up the shareholder vote, which, if they had not done this, shareholders would have likely voted on it on the deal in June. Now this is going to push it up to April. So definitely speeding things up and kind of really putting the ball in Paramount's court, so to speak. Paramount now really has to come up with some kind of a response. Either they sweeten their bid or extend the tender or simply walk away. So we'll have to wait and watch.
Geetha, how confident, in your opinion, should Netflix be that regulators approve such a deal? Because, of course, Paramount argues it's anti-competitive.
Yeah, there is still, it's kind of a little bit of a black box there, Josh, because it looks from the initial looks of it in the US, it feels like regulators might actually give them some leeway, just because they're arguing that, it's not just that they're competing with Disney Plus or Paramount Plus or Peacock. They're really going up against the YouTubes of the world, the TikToks of the world. And so that's really how they should be viewed in the context of the entire market. Now, it gets a little bit more hairy when you get to other markets like UK and some of the other European territories where it looks like they have much higher concentration. So antitrust risk definitely can be a huge problem in some of the European markets. So it's going to kind of be a market by market, and it's going to be a tough, long slog, in my opinion.
Geetha, always lucky to have you on the show. Thank you so much for joining us. Appreciate it.
Thank you.